I think that's the easiest way to do it. Wissam, you need to enable the screen sharing for me.
Yeah, let me do that as we speak. All right. Okay.
Okay, very good.
You should be able to do it
now. Yeah, okay, I think now I should be able to do it. Yeah. Okay, there we go. And we'll go. Okay, so I think can you confirm? Can you see my screen now? Yeah.
You can see your screen.
Very good. All right. So I would in the 20-30 minutes that I have, I would basically what I'll try to do is I will show you some graphs with some numbers. But I don't want to make the discussion too technical. So I would advise you to draw your attention at the graphs rather than the actual figures, because the figures, first of all, they come from data collected on national statistics from Lebanon and Greece, and national statistics in any country, they are notorious for being quite inconsistent over time. Countries tend to revise their, especially the public finances figures all the time. So what I want to do is I want to draw a qualitative picture, a narrative of how a crisis, how a sovereign debt crisis comes to be in the case of Greece and Lebanon, and draw some parallels between the two cases. And I will try to argue that there are quite a few parallels, not quantitative, so not in terms of scale. The scale of the two countries is different, and the scale of the debt problems is different. The debt problem of Greece is much higher, much larger than that of Lebanon, even relative to the economy speaking. But in qualitative terms, the narrative has some similarities. So I will start with a short, or maybe not so short, summary of the Greek case. So what happens in the case of Greece, and I will argue that it's much the same also for Lebanon, is a sovereign debt crisis, so a crisis in which the government is not able to repay its debts. That is directly connected, though, and to some extent stems, is caused, if you want, by the operation of the financial system, and in particular the banking system of the country. Because in a case like Greece, the financial system is essentially dominated by the banking sector. So what you see here in this figure are three graphs, three timelines that are directly related. One feeds into the other. One is the nominal growth of the GDP. And I'm presenting here the growth in nominal terms, not in real terms, because what matters for your ability to repay your debt is your nominal level of a GDP, okay, not the real level of the GDP. Now, the other graph that you see is the budget deficit, the blue line. And you see that basically the Greek crisis essentially came to be. The party stopped in 2009. This was the starting point of starting being in a situation of default, essentially as a country. And the situation basically starts from the late 90s when the country is preparing to enter into the euro. Officially, we adopted the euro as our currency in 2002, January 2002. But basically, since 1996, we entered into this period of a succession of austerity programs, of tightening of monetary policy, in order to bring us to the situation that we would meet the criteria, the public finance criteria to enter the Eurozone. And what matters here is that this meant that we start a period of decreasing inflation and decreasing interest rates. Now, this translates, feeds into the beginning of a period of credit expansion from the banking sector. And that feeds basically budget deficits, because the government is able to finance these budget deficits by borrowing, by issuing government bonds. These government bonds are bought primarily by the banks. And the banks are using these bonds essentially as collateral to borrow more money from the European Central Bank. This is how the European system works. I will do kind of a short parenthesis here. In the Eurozone, you might know that now European governments, governments that participate in the Eurozone, they're not able to print their own money. The money supply basically is generated in terms of primary money, in terms of cash notes by the European Central Bank. But in terms of credit, and if you look at any modern economy, the vast majority of the money in circulation, of the money supply, is basically credit, what is called commercial cash in the terminology that monetary economies use. So it's basically credit generated by the banks. So the banks basically, they take the government bonds, they use them as collateral in order to borrow money from the European Central Bank, and they use this money to make their loans to the domestic economy. So that cycle of the government issuing bonds that the banks in turn use as collateral to borrow more money and to basically generate new money supply in the economy fits the cycle of financing the budget deficits on the behalf of the government. And of course, budget deficits means that you expand the money supply in the domestic economy. And in a case like Greece, this ends up feeding into the current account deficit. So you end up importing much more than you exporting. And essentially, we create now a credit cycle that has to continue to be in order to finance this GDP growth, that it is a consumption-led growth. And a consumption-led growth that is, again, basically financed by these current account deficits. An economy like Greece is primarily, and I will draw a parallel here to the Lebanese economy as well, it's primarily based as a service economy. So the biggest amount of GDP is generated by the non-tradable sector, the sector that is not producing to compete directly with the world markets, but rather it is based on producing domestic services. So in order, therefore, to support the supply of domestic services, you need aggregate demand. And again, this aggregate demand is being funded by this debt, by basically borrowing money from abroad. Now, that, of course, something has to give here, so you can't get a free lunch. So what is happening, of course, is that you end up with increasing your debt. Now, debt, as we all know, is essentially a contract in which you are trying to consume today in order to somehow be able to, sorry, not consume today, you borrow today, the idea fundamentally being that you borrow today in order to invest in some productive asset that will increase your productive capacity to produce in the future, so to generate future income in order to pay back your debt. The problem in the Greek case, and again, I will draw a parallel here to the Lebanese case as well, is that if you're not using these sums, the money that you borrow, if you're not actually using them to create productive assets to increase your productive ability, the productive capacity of the economy, but instead you are using it to consume, you have a problem. Okay, essentially you are creating promises that you are not able to maintain, you are not able to keep. So the bubble will have to burst at some point, and that point in Greece came in 2009. Now, what is interesting in any narrative of a crisis, of a financial crisis, is two things in my view. One is how do we maintain this cycle of being able to borrow, and instead of increasing my productive capacity, I consume instead. How am I able to maintain this for the time, the timeline that I was able to maintain it? So in Greece, we were able to maintain it for nearly a decade. So the question arises here, why do people keep on lending you money? Well, the answer is that as long as I am able to make the interest payments, so essentially, as long as I am able to roll over my debts, my creditors are happy because they are receiving the coupons, they are receiving the interest payments. So they think there is no reason why I shouldn't be able to continue doing this in the future. Now, what breaks the cycle in the case of Greece was the financial crisis of 2008, so the subprime crisis in the US, that basically forced the banks, in particular the European banks, big German and French banks that they were holding a big part of the Greek debt. They forced the banks to reconsider this model, in the sense that the banks, they realized at some point that we have an issue. We don't know to what extent and how much we are exposed to the subprime crisis in the US. So we need to recapitalize ourselves. We need this cash, instead of keep on lending it to Greece to roll over its debts. We need to keep it in our balance sheets because we need some capital, we need some equity to cover our potential exposures to the subprime loans that we might have on our books. So what happened is that suddenly your creditors stop lending you. And now the crisis basically erupts, because suddenly I'm not able to roll over my debts. Now, what happens here, and I will show you a very similar graph in a minute about Lebanon as well, is that people tend to think of, at the beginning of a crisis, when it erupts at least, they always tend to think of it as a liquidity crisis. The government is running a huge budget deficit. So in 2009, the deficit of the Greek government ended up being close to 16% of GDP. So that was a huge shock for the markets in particular at the time, because the then government was also manipulating the books. So it had announced at the beginning that the deficit would be about 6 to 7%. And then 3 months later, they announced that, by the way, we made a mistake and it's going to be 16% instead of 6. However, the situation the point that I'm trying to make is that people tend to focus on liquidity at the time of the crisis itself, when the crisis started. And what they tend to ignore is that a liquidity crisis, when you're talking about sovereign debt, a liquidity crisis always comes in tandem with a solvency crisis. There is no just liquidity crisis when you're talking about debt. And this is not only the case for governments, it's also the case for companies. Liquidity comes together with solvency, And you see from this picture that the big problem for Greece at the time was that we had issued a lot of bonds, but over time, but in particular, we had issued a lot of bonds in a very short window between essentially 2005 and 2010. We ended up issuing nearly half of our debt. Now, why this is important? This is important because how are you able to issue so much debt altogether in such a short time? Well, the way to do it is by decreasing the maturity of this debt. So what we ended up doing, essentially, we changed dramatically the maturity profile of our debt. So we enter into a situation where the maturity profile of the debt was on average 15 to 20 years. And we turn it over to a maturity of an average of 5 years. And this is why I'm saying that you always have to think about the solvency along with the liquidity, because you end up now with a picture like this. So in 2009, where you see in this picture, this is the maturity profile of the Greek debt in 2009. So what you can see from this picture is that basically, suddenly Greece had found itself at a point where by 2014, so in 5 years, we had to pay out 135 billion of debt that will come to mature. So we're not talking about liquidity. So this is no longer the case of being able to meet interest payments or coupon payments or a couple of billion of bonds maturing every year. Suddenly we had basically to, if you take the horizon up to 2019 that I have it here, the total amount of debt that we had to pay back by 2019 was roughly 220, 230 billion, which was more or less the amount of GDP, of the Greek GDP in 2009. Now, there is no way, it hasn't happened in history, no country is able to repay the equivalent of the entire GDP, the entire 1 year's GDP in 10 years. That cannot happen. To give you, to put things in perspective, even if the economy was growing at an annual rate of 10%, which is basically an unheard of rate of growth for Greece. It's essentially the rate of growth that China has managed at its best of years. Basically, but even if you take this fictitious scenario that for some reason the GDP would be growing at 10% between 2010 and 2019, would still have to be paying back an average 7.5% of GDP per year in order to repay back this debt. This is simply not feasible. Okay, it can't be done. So essentially, what is happening with this crisis is 2 steps. First, the bubble bursts because suddenly you get a liquidity shock. So I'm not, for some reason, again, in the case of Greece was the subprime crisis. For some reason, there is an exogenous shock and the creditors are not willing to provide with you with short-term liquidity to roll over your debt. But then immediately after that comes the realization that, oh, wait a minute, if I look closer at the profile, the debt profile of this borrower, I realize that this country is not able to repay its debt periods. So I have a solvency problem. And of course, the latter, the solvency feature, matters a lot because it constrains heavily the question of how we're going to solve now, how we're going to get out of this crisis. And both in the case of Greece, and I will argue also in the case of Lebanon, when you are into solvency issues, the only way out has to involve some sort of restructuring. There are two ways to restructure a debt profile. One is to cancel some part of the debt. The other is to increase the maturity of the debt. So to try to basically strike a deal with your creditors in which you maintain the same present value of the amount that you own, but you increase the time during which you have to repay that amount, so that essentially you are able to decrease the annual payments, the profile of annual payments that you have to make to repay the debt. Now, this is a similar, well, again, as I said from the beginning, I want to qualify my claims. When I claim that similarities, I'm referring to qualitative similarities, not quantitative similarities. But I want to basically show you this graph. This is Lebanon now. This is the data about Lebanon. But you see that the description of what is going on is, in my view, quite similar to the Greek case, because also in the Lebanese case, what you are trying to do is you are trying to sustain a growth model that is based, again, almost exclusively on consumption. You are trying to maintain GDP growth by increasing aggregate demand, okay, domestic aggregate demand. And this, of course, comes through budget deficits that essentially go to finance current account deficits. So what is happening in a nutshell, you can describe it as the government is borrowing money, is pumping money into the economy to sustain aggregate consumption, to sustain domestic consumption. And that consumption basically ends up sustaining a non-tradables, a servicing sector, and imports, okay, imports from abroad. The question always is, where is the money coming from? So the Lebanese government here, again, it issues bonds. The bonds are purchased by the Lebanese banks. Like in the Greek case, a big part of the Greek debt was being bought by Greek banks. The question is, where do these banks find money? In the Greek case, as I said, the money was coming by the Greek banks borrowing money from the European Central Bank, using the Greek government bonds as collaterals. In the Lebanese case, the money is coming from abroad, from basically a big part being what you will see in a minute as foreign direct investment, basically remittances or money from Lebanese expats that are being deposited into Lebanese banks. So this is the money that the banks are using to buy government bonds, and of course also make loans to Lebanese residents as well. And again, a similar picture as we saw in the Greek case. The price you have to pay in order to sustain this model is, of course, an increasing timeline of debt, increasing basically obligations, IOUs. You're issuing promises that you will repay all this money in the future. And you also have a similar graph, again, not quantitatively, but qualitatively, a similar graph as the one I showed you in the Greek case with the maturity profile of the debt. So when the crisis erupts, 2020 being the case for Lebanon, 2009 was the case for Greece. But again, what the realization comes where you see that it's not only a liquidity crisis that I'm facing, it's also a solvency crisis, because I will have to pay back a huge portion of my GDP in maturing bonds. Here, if you look at the numbers for Lebanon, what I have in the picture, it amounts to roughly 17 billion of US dollars worth of bonds that come to mature in a decade up to 2030. Now that amounts to about 30% of 2019 Lebanese GDP figures. And also I have to qualify this further with the fact that the numbers that I found for the Eurobonds that the Lebanese government has issued, so these numbers that you see on the board, they account only for half the actual Eurobond debt outstanding of Lebanon. These are the numbers, the maturity details that I was able to find online. So, but you get I see the point is obvious that we also have a solvency problem. Okay, the two again, they always come together. It's never just a liquidity issue. It is always also a solvency issue when the point of reckoning comes. Now, okay, the question now is of interest, what happened in the Greek case? So how did we come out? Well, we haven't come out of it. I guess we're going to discuss a bit also the political dimensions and the social dimensions of the situation. If you go and talk to Greeks now, this seems to be somehow forgotten, things of the past. So people tend to move on. But the fact remains that we still owe a mountain of debt. Now, the question is, how did we survive the short term? So what happened in the Greek case? Now, the qualifying feature of the Greek situation was that when if we go back in time in 2009, a sizable portion of the Greek debt was being held by big Eurozone banks, in particular German banks and French banks. Now, if you see in this graph, the numbers here, the German and the French banks together, they used to hold around 19 billion worth of Greek debt. Now, 90 billion was roughly a third of the total debt at the time. Now, this was important because if we remind ourselves, we are in 2009, so we are in the midst of the financial crisis of 2008. So banks are panicking all over Europe, especially the big banks. So it is imperative for the German and the French banks for something to be done about the Greek debt, because they are already exposed through intermediaries and special purpose vehicles, so off-balance sheet items. They are exposed to the subprime crisis. They cannot afford to be exposed also to a Greek default. So they can't afford for these bonds that you see here to be suddenly worthless if the Greek government announces that it is unable to make payments. So what happens is there is a scramble in European institutions for something to be done about the Greek case. Now, the scramble results to the first rescue package. Now, the package is initiated, is funded by three institutions, and hence the term Troika that people are using to describe them. It is the European Commission, the European Central Bank, and the IMF. Now, the European Commission represents basically a number of European countries, mainly Eurozone countries, that agreed to come together and essentially produce bilateral loans to the Greek government. So the European Commission basically represents these countries. The European Central Bank lends its own money to the Greek government, so it is another party to the agreement. And the IMF also extends its own loans to the Greek government. So the first package comes in 2010. The nominal value was 110 billion euros. Now, the actual outstanding debt of Greece at the time was about 290 billion. So what this rescue package basically represents is an injection of cash to the Greek government with the purpose, with two goals. One is for the Greek government to be able to finance its deficits for the period 2010 and 2014, so for 4 years, and to be also to pay back the bonds that mature during these 4 years. The horizon, therefore, of the first rescue package is 4 years. It's being financed roughly at a rate 70-30 between European Union and IMF. Now, what is the aim of this package? The aim of this package basically is to enable Greece to be able to make the debt payments that mature between 2010 and 2014, essentially so that the banks that are holding this debt, and they are mainly French and German banks, there are also, of course, Greek banks and other Eurozone banks, but they are banks, essentially. So for the banks, for Greece to be able to make the payments to banks so that the balance sheets of these banks, they do not have the problem because they have to weather the financial crisis that is originated from the US. Now, I will show you first this picture because I think it is telling. So here are the projections of the rescue packages for the period from 2009 to 2014. Now, what is interesting here, where I want to draw your attention to the differences between the first line, the line with the asterisks, which are the projections of the Troika, of the creditors at the time, with the bottom line, which is the actual numbers. So what happened is that they heavily underestimated the impact of the crisis on the Greek economy. They were projecting much lower primary deficits than they actually realized. And of course, the discrepancy came because the GDP, the economy collapsed much more than they were planning to. And I will go into more details if you want of why this happened, but maybe I should leave it for the end of the presentation. Now, in accounting terms, when you get the primary deficit wrong, what you get wrong is the ability of your borrower to repay the money. So the plan of the first rescue package, sorry, let me go back there. So again, the plan of the first package was for the country to be able to stand on its feet for 4 years, so that it will be able to go back to the bond markets from 2014 onwards to start refinancing, rolling over its debt again. This didn't happen. It didn't happen because the loss in GDP was much larger than expected. So Greece was not able to do that. And the realization came as early as 2012. So 2 years into the program, the Troika, the creditors, they realized that this is not happening. So Greece actually needs a new package, because the first one wasn't even enough for the country to be able to finance its deficits, its primary deficits in the meantime. So the second package comes, and this is the important, in my view, package. This is the actual rescue package. So that came in the form, in binary form. So people call it the PSI OSI rescue package. So PSI stands for private sector involvement. OSI stands for official sector involvement. The official sector represents the Troika, the European Commission, the ECB, and the IMF. So for their part, what they did is they gave us a new loan, or nominal amount 173 billion euros. But this time they extended the horizon of the loan tremendously to 30 years. So that enabled basically a new profile of maturity that allow the country to be able to repay, to make the payments, the annual payments, because of course, the longer the maturity profile of your debt, the smaller are the annual payments that you have to make to meet interest and capital and principal payments. At the same time, the private sector involvement refers to a heavy restructuring of the private debt, so of the debt that was held mainly by banks. So what happened there was that the banks agreed to a heavy haircut that amounted to close to 45% of the nominal value, of the face value of the debt. And the way they did it is essentially they exchanged the bonds that they were holding with new bonds issued by the Greek government that they had the same basically profile, the 30-year profile, with also the loans from the Troika. And you see also that the other important difference between the first and the second package was the gradual withdrawal of the IMF from the process. The IMF burned itself a few times with the Greek case, and I think probably I will leave this for after the slides that I want to show you the extent of the IMF involvement and the different dynamics between the creditors that happened there. But for the time being, so it's clear now that the IMF is withdrawn itself, even with the second package. And essentially, in the third package that came in 2015, what's much smaller than the first two, in that package, basically, the IMF maintains a supervisory role. It is not a creditor in terms of providing any further money. Now, I have to say that the IMF involvement in the Greek case is basically the biggest loan the IMF has given to any country in its history. Actually, the IMF had to change its statute, its constitution, to be able to lend Greece that amount of money, because up to the point, the amount of money that a country could borrow from the IMF was always constrained by the special drawing rights, by the size of your contributions, your past contributions to the IMF. This had to change completely in order to take into account the Greek case. And again, the goal, the reason why they had to do that was essentially the first rescue package that they had to scramble to save the banks to make Greece able to repay the bonds that were coming due from between 2010 and 2014 to the European banks. Now, there is a difference, of course, between nominal values and present values when it comes to rescue packages. What I have here is basically the net obligations of the Greek government to the Troika as a result of the rescue packages. You will notice that these numbers are quite different than the numbers that I showed you before. In the first package in 2010 involved a nominal value of 110 billion euros. The actual present value, the actual obligation ended up being zero. Why is this? Because the rescue package that came in 2012 with the haircut that we saw from the private sector loans, from the bank loans, that amounted roughly to the same figure as the 110. So basically what we took on as debt in 2010 was cancelled for us, for Greece, in 2012. So what basically was left from the 2012 package was the new loans from the official sector, from the Troika. And even out of these new loans, whose nominal value was about 140 billion euros, we saved a large amount because some of that package went to recapitalize the Greek banks, because the haircut also affected the Greek banks. When I'm talking about private sector involvement, I'm talking about banks, European banks, including the Greek banks. So when you impose a haircut on the private sector, you impose losses on the asset side of the balance sheet of banks. So a typical Greek bank would hold a Greek bond that would have a face value, let's say, of 100 in its books. After the restructuring, the value of that bond would come down to 55. So there is an asset loss of 45. Now, when you lose assets, you need to recapitalize the bank, otherwise the bank would go under. So part of the 2012 package went to recapitalize the Greek banks. Now, some portion of the Greek banks was owned by the Greek government, because the recapitalization involved basically the government putting money in the banks in exchange of shares. So what I'm doing in this calculation here is I'm basically accounting for the fact that you are borrowing money, but you're using some part of that money to recapitalize your banks. And because you partially own these banks, if you account for the share value of the Greek government in the Greek banks at the time, which was roughly 25 billion, according to the share prices of the stock market at the time, you have basically this is it's a net effect of zero, because you are borrowing money and essentially you're putting it into an asset that you own yourself. Now, this is a picture of the maturity profile in 2012 following the restructuring. You see that this is very, very different than the profile that I showed you before, that the vast majority of the debt was due within a decade. And this is a fundamental feature of any restructuring problem. In order, again, to even start hoping that you have addressed a sovereign debt crisis, you have to do something about restructuring the maturity profile of the debt. Otherwise, the economy will not going to be able to meet its debt obligations. Now, this is the situation in the third rescue package in 2015. Now, as you can see, we started doing much, much better, right? From 2000, basically from 2016, the actual primary deficit starts beating the expectations of the designers of the rescue packages of the creditors. Now, why this is important? It is important because the primary deficit is counts what there's a question? No, okay. So the primary deficit. I think there is an echo. I think. Let me fix this. Hold on.
Might be some feedback coming in, but go ahead.
Okay. Yeah. So the primary deficit accounts for the difference between revenues minus spending. So the primary deficit reflects the ability of the government to repay its debt obligations. You need to have a primary surplus to be able to have money aside, to have money left over in order to pay your debts. So the situation in terms of public finances started improving from 2016 onwards. Now, this is why people are optimistic that we will be able to start improving the situation. As I said from the beginning, I'm not that optimistic because still the amount of debt that we have outstanding is daunting in my view. And in real terms, you see the outcome of the 10 years, so from 2010 to where we are today, of trying basically to address the crisis. The story of this picture is telling. This is GDP in real terms, in constant prices. And of course, what you see here is that in real terms, in real output, we ended up losing a decade. Okay, we are back here to essentially where we were in 2000. Okay, we lost, 20 years. So that's a long time in terms of lost output and lost growth. Now I will stop here, Wissam, and if you have some questions for me, if you don't, I can go on by. I would like also to talk about the socio-political dimensions of the situation.
I think that would be great. I did have some questions, and I would like to also open it up for people in this pause to pose any questions they may have for Dr. Diasakos. One of the interesting things you mentioned at the beginning was the price of exuberance, and so you're basically highlighting that the Greek economy, similar to the Lebanese one, is based on consumption and some exuberant spending that is fundamentally going towards imports and being fueled by foreign debt in the case of Greece, and foreign remittances or deposits in the case of Lebanon. A decade after the crisis, has the economic model of Greece changed to change these underlying dynamics of importing German cars and all that kind of stuff and sending this money outside but at credit? Or has there been a fundamental change in terms of how the economic model is structured in Greece?
No. And the thing is that I believe that it cannot change. Typically, when people talk about crisis, they always talk about crisis as an opportunity for change, an opportunity, a moment in time when collectively we have to realize that we have to restructure our economy. But unfortunately, this doesn't happen because you run against financial constraints, liquidity constraints. So from the creditor's perspective, first and foremost, they are worried about getting paid. They don't have the time, or they don't give you the time to restructure your economy. They primarily are focused on basically buying themselves time for you to be able to make payments so that they don't have to rebalance their own books. And because, restructuring an economy like Greece, Greece is an economy that is based primarily on services. Now, when you say that I will restructure the economy and try to move it into more productive sectors, that is always, by definition, it is a scenario that it requires time to realize. In order to produce things, you have to invest. You have to not only come up with the physical capital, but also the human capital, the requisite skills, and so on and so forth. So that cannot be done overnight. And it cannot be done also when you don't have the money to do it. So this idea that, we will come out of the crisis in better terms when we're talking about the structure of the economy, I don't think this is doable. I think restructuring should be done during the good times, during the times that the economy is growing and you have the money to reinvest into the productive sectors. Unfortunately, now it becomes a question of expectations, and that's why I put the exuberance in the title. When people are exuberant, when we think that we are living in good times and the economy is growing, no one from the parties, no one from the key agents in an economy, be it the political system, being the business sector, being we the people, no one really wants to incur the cost of restructuring, the cost of investment. Now, what is the cost? The cost, of course, is that foregone consumption. Or you have to forego consumption today in order to make the investment to produce something in the future. So during the good times, nobody wants to do that because, the argument always is, why should you change something that it works? Until you realize that it's not actually working. But then it is too late.
Yeah.
And unfortunately, that's a narrative, that's a narrative also in all financial crises as well. It's not only a political problem. It's generally, I think, a human problem, because also financial sector, pure financial crisis, not sovereign debt crisis, pure asset bubbles or pure banking crisis. Again, it is the same issue, that during the good times when people ought to restructure, they don't restructure because they think that they have a model that works.
Yeah, it's very interesting because there's also, and I'd like to open it up. If anybody has any questions, please raise your hands. We're also monitoring the ThawraTV channel in case anybody has any questions. But it's interesting that you highlight the political price of such painful measures. Talk us through a little bit, Theo. With Greece, you had 3 changes of government, and each one of the governments came with certain promises to the stakeholders. And here by stakeholders, I mean, we could look at clearly the Greek population, the Greek people, the banks or the private sector, and also the international community. If I'm not mistaken, the private sector, to a large degree, the banks, were wiped out, the owners. But correct me if I'm wrong on that. But how were the people, what was the role of the people? What were they demanding? What did they get? What did they not get? What did they lose? And in the case of comparing it with Lebanon, was funding to a large degree the debt from people's deposits. And so when the government defaulted, it fell down on, or at least it basically, to a large degree took it from people's deposits. So that's not the case necessarily with Greece, where most of the debt was being funded by the Germans because of all the imports that was being done by the Germans or French, et cetera, et cetera. So how do you see that comparison? And how does it play politically with how these politicians, the three waves that kind of accompanied the different packages, each package had a different government to come into office. How were they being influenced by the people and the politicians?
Yeah, no, that's an interesting, yeah, it's a very interesting aspect and very complicated, I'm afraid, aspect of the situation. So in Greece, I will start with the political sector, the political parties. So the first reaction of the government that came into in 2010. So in 2010, we had a change of government. So you had probably you had a situation in which essentially a government led us into the crisis, and then in 2009 they realized that they have to abort because they were manipulating the accounts, and essentially they had to abandon ship. So they called elections in late 2009. So from 2010 we have a new government, and that government. I think they were very slow to realize the extent of the crisis. And as I said, the key narrative at the time was that this is a liquidity crisis and we can weather it as long as we fix our deficits for a year or two. But then soon, within the first 6 months, they realize, actually, I don't think they realize themselves. Probably the creditors, the Europeans realized, and they revealed to them that they were facing a solvency crisis. So the problem was much, much bigger than anyone thought at the beginning. Now, the reaction of the then government, which turned out, in my view, to be quite unfortunate, was first of all to try to create this narrative of that essentially the political system of the last 30 years was responsible for this whole thing. Now, why this is unfortunate, in my view, it is because when you come to sovereign debt crisis, usually these happen in a very, very short time. You know, the problem, the debt might be increasing gradually over time, but there is always the case that if you look at a horizon of a few years, like 4 or 5 years just before the crisis, this is always the time when things can get really out of control. So when, like with companies, you know, when a company collapses, it might have problems for the last 30 years, but typically it is a huge management failure that happens in the short time right before the crisis. And so why does this matter? It matters because it essentially doesn't focus attention on the management of the problem. When you claim that, you know, we arrived on this crisis today because we have these huge cultural deficiencies and institutional inabilities that basically that we carry as a country for the last 30 years. Essentially, what you tell people is that, well, you live in a situation that things are not fixable, okay, or they, you know, it's a hopeless situation, and moreover, you create this narrative where nobody has an incentive to pinpoint responsibilities to certain actors that they were key actors for the management of the whole thing. So that was one aspect. Now, why this mattered? It mattered because it ended up creating this huge resentment in the people for the political system and the institutional framework of the country itself. So essentially, we had a situation where the society got radicalized, especially the people at the extremes of the political spectrum. So the extreme left got radicalized, and so did the extreme right. They also gain in terms of voters, in terms of political representation in the elections. So the extreme left used to hover around 5% in Greece up to 2010. The extreme right was never more than 3.54%. Suddenly, if you look at the elections of 2012, these two fringes together commanded something like close to 20% of the votes. And at the same time, when I say they got radicalized, that means these people came down to the streets. So we had to face huge demonstrations, distraction in Athens, complete chaos that was created for, during 2010 and 2011, on a weekly basis, we had huge demonstrations in Athens. So that was one problem in my view. And the second dimension is that because this realization came suddenly that the problem is much, much bigger than we thought, people started panicking. And when you panic, you tend to take measures that are not very well thought out. Now, these measures was essentially that, okay, first and foremost, we have to wipe out our primary deficits. As I showed you, there was also this hard constraint imposed by the Troika that you need to wipe out your primary deficits by 2014. So you have to do something radical. And doing something radical basically meant that they imposed these austerity measures across the board. So they reduce salaries to public employees. They nearly half the salaries almost overnight. And when I'm saying across the board, I mean that, you take a measure that reduces in percentage terms the salary the same for someone who is making, let's say at the time, 1,000 euros a month, the same for somebody who was making 6,000 euros a month. Now, as you understand, when we go down the distribution, the tails of the distribution, the really poor people, if you reduce somebody who is living on 500 euros and suddenly you make his salary 250 euros, this person is hurting much, much more than the person who went from 6,000 to 3,000. So, of course, somebody will say that, yeah, the person who was making 6,000 has also different living standards. There is a lot of adjustment to do, true, but one has to make an adjustment in the living standards. The other has to make actually an adjustment in standards that ends up being basically a situation of being able to survive or not. So the measures themselves, they ended up radicalizing a large portion of the population. And this is crucial because in order to be able to overcome crises like this, these are national crises in my view. So you need to come together and join your forces as a country, as a nation. You need to have some sort of common understanding that it's essentially a collective effort that we have to do. And we have to do with at least some minimum understanding of how we're going to share the burden. And as I said, sharing the burden is extremely important also for another reason, that crises come at the end of bubbles. Okay, financial crisis, banking crisis, sovereign debt crisis. Now, during the bubble, the reason why we have this model and we're trying to maintain it for as long as we can maintain it is that some people are benefiting from this. And large portions of the public usually benefited from Greece. So in the Greek case, basically we built it up the living standards of the middle class over this time. Now, the austerity measure, what basically ended up doing is that they wiped out this middle class nearly overnight. So you have huge changes in the social fabric of the country. That has a lot of political implications that sometimes political actors they don't take into account the government that came into 2010 and came up with this narrative that, collectively we fail as people, as a country for the last 30 years. Now, this was the socialists, and the socialists got completely wiped out in the process. They went from 40% of the vote in 2010. Right now, they are happy if they're going to go over 6%. So the center left got completely wiped out of the political representation.
That's interesting. The communists, the communists, when they came in on the during the second sets of negotiations, they basically moved even more left, or supposedly ideologically, and yet from a policy perspective, their policies ended up being very right and in line with their negotiations. I mean, with the IMF and all that. So the political players and the international community dynamic of how they negotiate was also interesting, because it's as if there was a dance going on between, who the next candidate or the party is and the international community that was owed this money. So can you explain a little bit the dynamic that you saw there?
Yeah, the dynamic was interesting because what happened was that there was a huge discrepancy between what the main players, the main political parties, the main actors of the narrative that they would sell domestically to their own constituents, and the narrative that they would go and try to sell internationally when it comes to the creditors, the troika. And the communist is a case in point. So domestically, they were selling this idea that the austerity programs are not working. Clearly, the country is collapsing. People are hurting. The GDP is falling. We simply cannot, we cannot meet these conditions. So the only way forward is for the creditors to realize that these conditions will have to be removed, and they should basically lend us money without conditions. This was the goal of their political strategy that we're selling domestically. Mm. But when they were going abroad, with the communists, it took them basically about 6 months. They came to power at the beginning of 2015. They really sat at the negotiating table at the summer of 2015. And when they got to sit at the negotiating table, they accepted every single conditionality that was put in front of them. And actually, the conditionalities that they were put in at the time was much, much more severe than the conditionalities that they were proposed at the end of 2014. Why they were more severe? Because in the meantime, when you're not negotiating for 6 months, what happens is that the leverage that the Europeans had was that the European Central Bank essentially cut the money supply to the Greek banks. They declared that we're not going to be lending you any more money. So domestically, we had the government had to impose capital controls on the banking sector. So we had a huge loss of GDP over 6 months, precisely because of the capital controls. And when you return at the negotiated table at the summer of 2015, your position is much, much weaker than it was in the January 2015 when you left the negotiating table.
Which is interesting. I think in a conversation we had with the Venezuela, he was also highlighting the same thing, which is sometimes the deals that appear to be very unfavorable, if you project it 10 years forward, they're a small proportion of where you end up, being or forced to being after things deteriorate even further.
No, that's exactly the. I remember that in December 2014, just before the elections, the then Minister of Finance had sent an email to the IMF trying to argue about some of the conditionalities proposed at the time. And that email leaked in the press. And there was an uproar, and basically this is what caused the elections. And the then government lost the elections. And I remember that guy said afterwards that, look, the way we're going, those conditions, they will look like a walk in the park compared to the conditions that we have to face later. And this actually was ended up being the case. And the reason being is actually simple. I mean, people don't want to admit it, but it's always reality. When you are negotiating with someone, either you have something to offer or you need to have the power to demand. There is no way of negotiating with a creditor simply because you are threatening that you know, I'm not going to be meeting these conditionalities, but by the way, you know that I can't survive without your money. Okay, when you're dependent on the creditor for your cash flow, you don't have any leverage. You have to realize this. So the only way, in my view at least, to present your case is to try to convince the creditor that it is also in their best interest to amend the conditionalities in order to help you make back the payments. So the IMF itself came to realize in 2014 that their own projections about the Greek economy were wrong. They had basically underestimated the effect of the multiplier, the government spending multiplier in the economy. And they realized as themselves that basically the austerity measures that they imposed in 2010 created much more damage than good, even for the perspective of the creditors. So yeah, I mean, negotiating in such situations is really, really difficult. And but the onus on the politicians and the political system is to manage the expectations of the population, the domestic expectations. And in Greece, what cost us dearly in terms of lost GDP over 2 decades, essentially, as you see in the graph, is the very fact that all along the political parties domestically were feeding people with their own expectations about the whole process. That somehow there was an easy way out. Somehow you can just essentially, bang your fist on the table and demand from Mrs. Merkel to remove the conditionalities. As you know, not realizing that, especially when you're talking about the creditors being countries, they are also at the other end of the negotiating table. You have also political actors who have also voters that they have to appease. They have also their own political agendas domestically. They have their own agendas and their own interests. Yeah. So you have somehow to try to get into the other party's shoes in order to manage their expectations. And of course, as I said, you have to manage your own people expectations, because this demands a huge collective effort, a national effort on the part of the country to get the country out of this mess.
Yeah, I'm going to come back to this point. Tala has a question. Tala, would you like to unmute yourself and pose your question, please?
Yes, sure. Can you hear me?
Yes, loud and clear.
Great. Well, first, Theodoros, thank you very much for this presentation. It was quite interesting. And with my question, I'd actually like to circle back to the very first question that was being discussed earlier with Wissam and yourself. And it's more on the side of, okay, so there was a crisis. It took 20 years of work, basically just dealing with the effects of this crisis rather than restructuring and dealing with the cause of this crisis and mitigating around further crisis. And then in 20 years, we come back at the same point as you highlighted in your presentation. So with the same conditions, with the same economic model of the country, with the difference that the creditors, or the troika as you call it, are way more reluctant, I imagine, to lend more money. So what is it that has stopped Greece from falling back into another crisis or going in a cyclic or activity or in a loop?
Like Argentina as a case of an example, basically, Tala, it's the same case in Argentina where every 10, 15 years they seem to come back into the same credit kind of a crisis.
Yeah, absolutely. So how do we break out of this?
No, yeah, that's a very good question. So in the Greek case, what has helped a lot is the fact that we are part of the Eurozone bloc. So the very fact that, I mean, if you compare it, for instance, to the case of Argentina, is an excellent comparison. The restructuring of the Greek debt involved the Bank of International Settlements, that essentially it's a body that represents all the big international banks. So it was a collective agreement, you know, the creditors agreed to restructure the bonds. In the Argentinian case, basically the country did it unilaterally. It defaulted without the creditors being in agreement. And that problem has come to haunt them until now, that still there are cases pending in courts with the Argentinian debt, because bondholders, they don't recognize that their bonds were restructured, or they don't accept the haircut. So they demand still the full payment. So Greece was extremely lucky in the sense that once you have the seal of agreement from the Bank of International Settlements, then that's it. You know, that question is closed. The creditors have agreed to change their bonds. Legally, you're covered. This is the end of story. Now, the question, of course, is how did Greece manage to do this? Well, it managed to do this because basically the banks were strong-handed by the European Commission and the IMF. These big institutions that, you know, they have leverage, of course, because even if you are an American bank, you want to be trading in the European Union. So if the European Union tells you that we need to do something, you have to do it. So if the EU and the IMF, they come together and they demand this settlement by the banks have to oblige. Now, why the European Union and the IMF wanted the settlement? The IMF here is the key actor. We typically love to blame the IMF for all troubles because the IMF always comes in with really harsh austerity programs, really difficult conditionalities that are really short-term and difficult to be met. However, to their credit, in the case of Greece, the IMF from very, very early on were the only institution that was adamant that the Greek debt needs restructuring. Even the European Commission for a long time was completely against this idea. They didn't even want to hear it, especially between 2010 and 2012. They didn't even want to consider it because, as I said, they didn't want to face the problems that they would have to face with their own banks if the Greek debt was to be restructured. But the IMF insisted all along, because basically the IMF is always in a difficult position when it comes to lend to a country, because according to its statute, it cannot lend to any country if it cannot prove in quotations, if it cannot show you a scenario, a hypothesis, under which the debt of the country is solvent, so under which the country will be able to repay back its debt. So the IMF basically was in a very, very tight spot, because on the one hand, it was feeling obliged to lend to Greece. And as I said, the amounts of loans that it had to give was unprecedented for the IMF. But at the same time, it had to do it in a way that it could justify that Greece would be able to repay back its debt. So it came a point where, they realized that the IMF, and then from that point onwards, they were heavily trying to promote this, that the debt would have to be restructured. So Greece was very lucky in that respect compared to Argentina.
Plus, it was the first feared at the time, that it was the first domino in a Southern European kind of,
no, exactly. Yes.
So
Yes.
stopping the domino from falling there. There is one element of Tala's question that I think remained unanswered, perhaps, which kind of goes back to the point of restructuring an economy. I guess she was also trying to allude, and correct me if I'm wrong, Tala, but she was trying to say that, if the restructuring of economy has not happened, and it's still based on the same kind of, which is the Lebanon case, on imports, etc., which are, if I'm not mistaken, about 4.x times the number of exports. So there's clearly a trade deficit right there that's outflowing dollars constantly. In such a case, if there is no restructuring, then is it inevitable that this, this financial crisis will recur at a certain point in the future? Or is there a way that, some other mechanism to turn things around without fundamentally restructuring the economy?
No, in my view, no. And so to actually answer the second part of the question, I think what probably what we want to clarify here is, okay, how come we believe that, at least in the Greek case at the moment, how come some people think that we are back to normal, since we have all this amount of debt outstanding? So what happened to the creditors? Why they haven't, they are not worried? I think the first of all, on the one hand, what has happened is that the IMF now is out of the picture. The IMF has been repaid, so it has withdrawn itself from the debt problem of Greece at the moment. So whether or not the remaining debt is solvent, it's no longer the IMF's problem. Now, what about the Europeans? Well, the question for the Europeans is that the Greek problem is no longer, an item that is high on the priority, because you have to take into account that, the numbers might be daunting from the perspective of Greek GDP, but they are insignificant, they are trivial from the perspective of European GDP. We are a tiny country compared to Europe. So, I mean, to put it crudely, even if we default tomorrow, at the moment, nobody will really care from the big countries of the European Union. So it's, I think, in my view at least, the problem is still there. People are desperately trying to ignore it because, again, we go back to the political dimensions. The failure of managing people expectations still goes on in Greece. So now the narrative of the governments is that we saved you, we solved the situation. So now things are back to normal and everything will be better, without, of course, explaining to anyone how we will be able to pay back the debt over time. Essentially, this is the problem, that now what we're doing is we think that we can afford to kick the can to the next generations. The problem, that's what we are doing. We're just postponing the problem in the future. Yes, if you don't restructure the economy, the problem will always be there. Now, the question is, okay, how do you restructure an economy? Can you restructure an economy? Now, in the Greek case, in my view, this is very, very problematic because we are part of the European Union. And the fact that we are in the single market means that it is extremely difficult for us to compete in terms of productivity, in terms of creating products that have added value and therefore a substantial profit margin with the big economies of Europe. because when you're coming out of a history of almost a century in which the European economy has been structured so that economies like Germany, for instance, they essentially now you can view that Germany is specializing in heavy manufacturing. France is essentially trying to specialize in financial sector. But basically, so now what you have is that you are left with small countries like Greece with a model that is the only way for this model to work is through current account deficits. We don't produce, so we have to import from the big European economies that they are manufacturing goods. And what we try to offer in exchange is essentially services like tourism that gets you some sort of foreign reserves, or it's some sort of export, but still it doesn't account for much of GDP if you look at the big picture. But it's very difficult to restructure, because restructuring means that you have to compete directly with countries and sectors that already have the know-how. They are established in terms of market shares in the global markets. It's really difficult to do.
Yeah.
And I think also there is on top, maybe just on top of that, Theodoros, there's this point that, well, I wonder how this plays in on a political level, but you might want to try to restructure your economy, be more productive, but then the same, let's say the creditors, but in terms of public sector, let's say, or other countries or foreign banks that you do trade deals with, for example, might not want you to develop your, and I mean, when I say this, I'm also reflecting the case of Lebanon, not just Greece and Europe, but also on one hand, they want you to be strong enough so that you can pay your debt, but not self-sufficient so that you don't need them and the credits that they give you, and also to not block any trade deals that they benefit of with your country. And given that, of course, they have the more power politically and financially, this puts a country in a difficult position to try to even restructure its economy.
Yeah, in Lebanon's case, you're right, Tala. In the case, we don't have restrictions in terms of, well, I mean, in the trading, being part of a trading bloc, there's a big advantage, such as the EU, but there's also some restrictions in terms of where you can go. In the Lebanese case, we do have freedom to go out in the market and trade essentially with anybody that we want, kind of what the British were hoping to get out of a Brexit sort of a thing. But at the same time, you don't have much of a safety net if things things go badly. So definitely, it's a concern. Restructuring the economy in the case of Lebanon, particularly from moving it purely from services, is never going to happen. But the proportions might change. For example, in terms of the level of imports, where you're importing from, the kind of repatriation of funds coming in, what they get applied. Plus, I think we have a big differential, kind of the elephant in the room, so to speak. Although GDP-wise, it might not be the game changer, but it will make a somewhat sizable difference, which is gas and the oil that are, just like in Cyprus, you may have, kind of learned that there were some large gas reserves, and they estimate that these could yield, depending on oil prices, somewhere in the 200 to 300 billion over the next couple of decades, because the first extraction cannot occur, even if it started now, which it hasn't, until the end of the decade. So there are some options that Lebanon has. But here I want to there is one question actually I would like to pose, and then I have a couple of other questions. Please, anybody else who'd like to pose a question, we have another 10 to 15 minutes before we end the session.
Can I just go back to the point you just mentioned with the restructuring sectorally the economy? That's a very good point. But what we are missing, I think, in the debate that has become mainstream now for the last 20, 30 years is that unfortunately, in my view, what has gone out of fashion is the role of national strategic planning when you're trying to restructure the economy and essentially you say, okay, let us try and develop this sector or that sector, it is imperative, in my view, that the government, and by government I mean a government as an entity, as a strategic entity. I'm not talking about the current government or the X political party or the Y political actor. I'm talking about a government as a institution that exhibits continuation. So you need a national strategy that will essentially will decide. You need a process to decide and then to implement a strategic plan that say, you know what, I want to focus for the next 10, 20 years, I want to build this sector of my economy. That cannot be done by the market on its own, because as I said, it requires some long-term investment and some reallocation of resources within the economy. So there are going to be some benefits, but that will come in the future, but also some costs that we'll have to realize at the present. So you need some a national narrative and a national agreement, a national unity to implement these sectoral changes. And unfortunately, even in the European Union, nobody really talks in these terms, in the terms of getting governments directly involved in this process.
Yeah, interesting. There's a question coming from Rashid. It's was there or what was an investment initiative taken? Was there an investment initiative taken by the diaspora, and which were some of the sectors that might be affected? I'm not sure if Rashid is referring to the case of Greece or the case of Lebanon. Rashid, please feel free to unmute yourself and clarify. But was there any outside influence on the Greek case, Theo, and in addition to the people as well as the international community? In Lebanon's case, the economic size of our diaspora is substantial, and over, I believe, from 1991 to 2020, the remittances on average have ranged somewhere between $5 and $9 billion annually, which comes out to quite a sizable amount, almost $200 billion. So has there been some kind of other influence from your diaspora, some sectors, etc.? And Rashid, I see you unmuted yourself. Would you like to elaborate on this?
Exactly. I wanted, good evening, sir. I would like just to find out about how they have their role for reinvestment after the crash, and what you advise the Lebanese diaspora in this respect.
Thank you, Rashid. Was there any influence of
Not really, no. And I think the reason being that when you're trying to talk about influence of diaspora, so basically you end up with a problem of having to coordinate many different actors. And the coordination problems are always there. In economics, it's always this this issue of how do we create coordinative mechanisms to solve problems like prisoner's dilemma and so on and so forth. And again, usually what happens is that you need some focal points. So you need to create some focal sectors for people to invest. You cannot expect the diaspora to wake up one morning and decide, in Lebanon, we have to create, for instance, a sector to produce energy. It will not come on its own. You need, that's what I'm saying, you need usually some sort of central direction here, some sort of a national plan that the government, of course, have to be behind, and you have to put some resources in it in order to coordinate investors to invest in a particular activity. And of course, this is, if you look at many successful economies, look at Japan, look at many Asian economies. I mean, look at next door to you, look at Israel. Israel is implementing these national strategic plans all the time. So you need a coordinating device, a coordinating mechanism in order to bring together, be it foreign investors, be it your diaspora, be it the capital that in the Greek case, the banks were bringing on for abroad. You need some sort of coordinating device to be there in order to ensure that these funds are going to be allocated in the productive sector that you want to create. Otherwise, what happens is that, money, investors, first and foremost, they are looking for profit. They are not looking to build economies for the long run or to restructure. That's not their business. So when I'm looking for profit, I want to, first of all, I will look short-term, much more short-term than I should from the perspective of the national economy. And usually what happens in economies like Greece and Lebanon is that if you are facing an economy, for instance, that is based on services, that implies that the relative prices within the country are already set up in a way that there are advantages to investing in the already existing sectors. Look, for instance, when economies like Greece, or Lebanon, when usually the easiest way to develop via consumption enhancing GDP growth is typically sectors like construction, housing. So these are the sectors where you have asset inflation. So when you have a booming housing sector, a foreign investor, when it was going to come in, he has an incentive to invest in the housing sector because this is the easy money to be made. I'm not going to go and put my money in a project that is very uncertain and might pay out 10, 15 years down the line when I compare my return with a very short-term return and much higher probably in nominal terms at least in putting my money in housing or putting my money in construction. So, we can't expect the markets to reallocate key sectors of the economy. Okay, they can, or private investors for that matter. Okay, they can't do it because they don't have the incentive to do it.
Yeah, it's I see that what you're kind of you've been emphatic in your presentation today about the importance of setting expectations and kind of like a more of a national plan that brings the different players together, because it is going to be painful, and it's kind of medium to long term outlook, which may not have immediate returns in the short term, but surely in medium to long term. This kind of raises the last question I'd like to pose, which is when you look in retrospect to the Greek case, was the I guess the division of costs fair? What was that division between, let's say, the people, the private sector, and the international community? Could it have been done? Could it have been more fair once things fell and a cost had been incurred by the overall exuberant society that existed before? Was the division in terms of the costs fair? Could it have been done more fair? That's an important lesson for us, because there's a lot of debates in Lebanon right now, which is, how much should the banks be paying the depositors? How much are the depositors going to have to bear? How much is the international community and particularly the bondholders within the international community that are in the minority, granted, are they going to have to pay, et cetera, et cetera? You guys already faced all of these choices. In retrospect, could you kind of fill us in a little bit on the overall fairness, or what could have been done better to have a more optimal outlook for Greece and for Lebanon potentially?
No, I would like to think that it could have been much fairer than it actually ended up, and I think that if we had managed to make the burden of the austerity programs, of the conditionalities, much more fairly distributed across the population, probably we wouldn't have the political drama that we had, and we would have lost so much time in going back and forth in trying to get basically trying to get back to a situation of primary surplus. Now, what happened in the Greek case is the way, the way I see it now retrospectively is that during the first rescue package, the main aim was to save the banks, the banking sector. And that meant basically that they had to guard the deposits. So during all the Greek saga, no one lost any money in terms of deposits. Of course, the banking sector lost a lot of deposits, but these deposits were either basically were people who were moving the money from Greece into abroad, into other European banks abroad, companies themselves moving the central offices from Athens to Brussels, for instance. Why? Because they could no longer raise money by issuing bonds under Greek jurisdictions because everybody was concerned about country risk. So therefore, they located the central offices, for instance, in Brussels, and therefore they were issuing bonds as Belgian companies. So a lot of money was essentially lost at the end of the day from deposits from banks. Not because we imposed capital controls from the beginning. Capital controls were imposed only for some months during 2015, very late in the process. But because people were moving their money because they thought that their money was not safe in the Greek banks. And at the same time, people were withdrawing their savings in order to consume, in order to maintain whatever they could maintain from the living standards, since the salaries were reduced. So in this sense, the guys who did not lose much were the depositors, the people who had money in the banks to start with, and also the people who had assets, real estate assets, because up to 2009, part of the good times that we were the exuberance period in the Greek case, you saw a lot of house price inflation. Now we had a decline in real estate prices for the period from 2010 to 2015, but still, in my view, at least, this was not even a correction for the bubble that we had faced in the previous 10 to 15 years. So the people who had real estate assets, they were able to maintain a sizable part of their wealth. Now, this was deliberate also by the government as a policy. The reason being that a lot of the asset side of the portfolio of the banks was in terms of real estate loans. So from the bank's perspective, you want to maintain the house prices because that maintains the value of the collateral, therefore the value of the loan that the bank has in its balance sheet. So from the government perspective, the reasoning is that I already have imposed a haircut on the banks because I restructured the government bonds that they were holding. So at least now I have to save their value in terms of real estate loans. Otherwise, if these collapse as well, I have to recapitalize them further. So these were two key parts of the population that where they didn't face the cost to the same extent as other sectors of society. Now, who were the other sectors of society that got hit really badly? The public sector employees, because the public sector salaries were cut nearly to half, 50%. And the same went also for private sector employees, because you had a lot of, one of the conditionalities was a deregulation of the labor markets, We used to have collective bargaining clauses and agreements in Greece. We don't have them anymore. So now the companies can essentially negotiate directly with the employees for the salaries. And this led to a sizable, a significant decrease in real terms in wages. So public sector and private sector employees, they got hit really badly. Now, up to 2015, there was a conscious and huge effort to maintain the living standards of the pensioners. So they try as hard as they could to not touch the pensions, but they had to restructure also the pension system from 2015. Now, the reason being that the pension system is a huge burden for the Greek economy. If you look at the figures, nearly 90% of the outstanding debt that we had in 2009 is the amounts to the amount of money that the government has given to the pension system in order to, so essentially, instead of looking at current account, you might as well, in the Greek case, look also at the pension fund, the public pension fund. So nearly all of the debt that we incurred over the years went to finance pensions. Now, of course, there is always here the political dimension. Greek society faces an aging problem, like many other Western societies. So pensioners are becoming more and more important in political consideration in terms of voting. Think also the fact that older people are more likely to vote than younger people, so to go to the polls. So you have basically a really strong constituency that you're trying to protect, and they protected them as much as they could. They had to cut significantly pensions from with the third restructuring package, like 2015, 2016. So I think, if you look at the income distribution, let's put it this way, in Greek society, what happened, and this is unfortunately usually the case with structuring, is that the poor people, at least in relative terms, they tend to hurt more than the people who have assets, and in the Greek case, who had also cash. So no, the distribution of pains is not fair. And as I said, had it been more fair, I think we had avoided a lot of, certainly in my view, we had avoided this radicalization of society that we have to live now with.
And the bank, finally, the bank owners were also hit, were they not?
Yes, so the bank owners, the private bank owners, so some of the banks were completely privately owned. Usually Greece, still has 4 or 5 major banks. So out of these 3, they used to be completely private owned. So the then shareholders got wiped out completely, with both with the crisis and with the restructuring of the debt. Now, if you remember, I mentioned that during the second package, some of the loan that we received from the creditors went to recapitalize the banks. Now, that at the time meant that the government, who was a partial shareholder in the 2 biggest banks at the time, was able basically to maintain its share value. Unfortunately, also that part got wiped out with the crisis, with the capital controls and all that we had to face in 2015. So with the third rescue package, basically when you impose capital controls, the value of the banks completely collapsed in the stock market. So even the government got wiped out, basically, a shareholder. And you ended up with a situation where distress hedge funds, they came in, and they bought the Greek banks. So yeah, the original shareholders of the banks, be it the government or the private owners, they got wiped out essentially. Yeah.
Okay. Well, Theo, I think this was a very, very informative session, and I wanted to really thank you for sharing this amazing, and complex story about Greece with us in Lebanon, because we're kind of about 10 years behind. But I wanted to thank you again so much for your time. And for those who are here, this will be a recorded session. So if anybody would like to see or share this with someone, it will be both on TTV, but it will also be available through the CCG and Arar community. So thank you all for joining as well. And with this, I think we've come to the end of the session. It has been a pleasure to host you, Theo. Thank you so much.
Thank you for inviting me, Wissam. It's been a pleasure.
Thank you.